Session on fixed income securities. In this session, we're going to introduce you to the market for fixed income securities, provide you a lot of detail on the characteristics of fixed income securities in general, as well as talk about the specific characteristics of different sectors of the fixed income market, issuers, investors, and a wide variety of concepts related to the analysis and valuation of those securities. So let's begin. Now, first off, it might be a good idea to talk about what a fixed income security is, to give you a sense of the general characteristics of these types of securities, as well as who creates them and why they're created. Well, in general, a fixed income security is any debt security or debt obligation. We'll talk about that in more detail in just a few moments. And they're created by issuers, that is, entities that are borrowing money by issuing these securities. And these issuers could be corporations, governments, government agencies. And when we talk about governments, governments from a wide variety of levels, from national or federal governments to provincial or state governments, all the way down to local governments and administrative districts. So debt securities have been issued for many, many centuries by a wide variety of different sorts of entities. And the markets for these securities are extremely large. In fact, the fixed income securities markets are a multiple of the equity markets. So that while equity markets oftentimes are getting more coverage in the popular press or the financial news, in reality the central gravity of the securities markets is the fixed income markets itself. In fact, if you look at the size of the fixed income markets relative to economic activity, which is oftentimes quantified by real GDP, fixed income markets are currently north of $100 trillion in value at current market prices, and you'll note that's a multiple of worldwide gross domestic product. And as far as the market sectors, I gave you an indication of that when we were talking before about the issuers of these securities. But when people break the markets down into segments, they typically distinguish between government issuers, government agency issuers, private borrowers, mostly corporations, as well as those lower levels of governments we talked about previously. And one item I've sort of skipped over on this first page here is what's fixed about a fixed income security. Because one sort of fundamental issue you need to get a grasp of is a handle on the specific terminology of the business, what's oftentimes referred to as jargon. And especially for people new to the markets, that jargon is one of the stumbling blocks. So we'll not answer the question right now, but just propose a number of alternatives, and we'll uncover the answer as we go forward. But when people think about fixed income securities in response to what's fixed about a fixed income security, now these are terms that we'll go over in more detail in subsequent slides, but many people think it's, probably the par value, which we'll define in detail later, but it's representative of the amount of money borrowed. But clearly, par value is not necessarily fixed because there are securities where the par value will be changed with the passage of time, things like inflation-adjusted or Treasury inflation-protected securities, or the par value or the amount of money that the issuer has to repay might be affected by things like the conversion value of the security, or convertible securities. The ultimate maturity value might be defined as the greater of, either the par value of the securities or the value of the securities the bond is convertible into. Now, many people guess, well then, what's fixed would be the maturity of the security. Well, most bonds have a maturity date, but in fact many bonds don't have a maturity date. There are such things as perpetual securities that don't mature at all. And even bonds that do have a maturity date, that maturity date might not be, at least in terms of the retirement of the debt, that might not be fixed either, because some securities are extendable. The maturity might be put off by the issuer. Some maturity is going to be shortened by the issuer calling the bond or bondholders putting the bond back to the issuer. So while most bonds have a fixed maturity date, that date is oftentimes uncertain. Well, many people might think that, well, then it's the coupon rate that's fixed, because many people will view the coupon as the income one gets from holding a fixed income security. And clearly many bonds have fixed coupon rates, but there are many fixed income securities that don't have fixed rates. There's zero coupon securities. Now, you might say, well, the coupon's fixed at zero, and I wouldn't argue that, but the point is there is no coupon. But there are floating rate or adjustable rate instruments where the coupon will reset at identified frequencies. Or there are what are known as split rate or step-up coupons where the coupon is going to change according to some schedule. So while most bonds have fixed coupons, again, there are many securities that don't have fixed coupons or at least not a constant coupon. And many people even think that it's the rate of return that is fixed on a fixed income security. And while that might not be a surprising interpretation that the rate of return is fixed, because most basic books on the subject of fixed income securities will define the yield to maturity as the rate of return an investor will earn if they buy a bond and hold it all the way to maturity. But that's a very gross misexplanation of what yield to maturity is. And even a few seconds of thought would have to disabuse you of the idea that that could possibly be true. Because given that most bonds do pay coupons, whether they're fixed or not, as we talked about before, clearly your rate of return to maturity will be heavily influenced by the reinvestment rate. That is the rate at which you're reinvesting all those coupons received over the life of the security. And if you can't know the reinvestment rate with certainty, how could you possibly know the rate of return to maturity? So while many people will mistakenly think it's one or a number of those things that are fixed, it turns out that it's not necessarily any of those. But we'll ultimately come back to answering that question after we've gone through an explanation of these and other bond features in a bit more detail. So we talked about the various sectors. Let's look at them a little bit more closely. So if we look at the markets for fixed income securities, I gave you a quote of the approximate size anyway, and clearly that varies over time. And while I cited the fact that fixed income markets are typically much larger than the equity markets, again, that's not a fixed ratio or relationship either. But in most of the developed economies, the public market for fixed income securities is probably anywhere from 2 to 4 times the size of the equity market in that same financial market. Now, with regard to the market segments, you see a listing of the sectors, and we'll talk about all of those sectors over the course of the session. And for most individual financial markets anyway, that's country markets, typically the government bond market is the largest of any market sector in a particular that's national financial market. But other significant sectors are the corporate bond market. In many markets, the corporate bond market will be a significant feature, half to almost equal to the size of the government securities market, in some cases even larger. There's also markets for what are sometimes in the aggregate called structured securities, because unlike the other obligations which represent the borrowing of a single issuer, these structured securities usually represent packages of credit instruments. Could be mortgages, could be credit card receivables, could be auto loans, or a variety of other things. But those are mortgage-backed securities, asset-backed securities, and collateralized debt obligations. Money markets are the markets for short-dated debt securities of any issuer, generally defined as securities having a year or less to maturity from the date of issuance. And then there's also other levels of government or government-associated issuers. That is the government agencies and the local or regional governments we talked about previously. And a detailed explanation of the history of the bond market is clearly beyond the scope of what we can discuss in this session, but just to give you a hint of it, the tradition has it at least that the bond market evolved from actually annuities created by the Italian city-states in the Renaissance. The city-states being at least nominally democracies where the upper middle classes and the well-to-do at least had some say in the form of government. Well, as we're seeing in today's environment, of course, democracies have a hard time not spending a lot of money to support the population and possibly buy votes. But in any event, the Italian city-state democracies running into financial difficulties would borrow money from their citizens. Sometimes it was a forced borrowing. But it wasn't just a seizure. The government would promise to pay interest on that annuity in perpetuity. And those claims, the annuities held by the Italian families, could actually be traded amongst one another. So that's actually, believe it or not, the first beginnings of the trading in fixed income type instruments that the bond market we see today evolved from. Slightly different meaning in the case of bonds versus loans. I mentioned a few moments ago the creation or issuance of fixed income securities. Let's look at that just a little bit more closely. Here we have an exhibit that tries to illustrate the idea I talked about previously. And the issuance or the creation of these fixed income securities is occurring in what's called the primary market. The primary market is the market where you have sales either by or in many cases on behalf of an issuer for that issuer to raise funds. So on the right-hand side of this exhibit, we have what is oftentimes referred to as the sell side. In other words, the parties selling the securities either to raise money or on behalf of those raising money. And the securities are acquired by what is commonly referred to as the buy side. That is the investing community, the acquirers of these securities for investment or other purposes. Well, the sell side is made up of the issuers of securities. And we talked previously about the categories of issuers of securities. Governments from national all the way down to local, corporations, or entities created as funding vehicles, the structured securities we talked about, at least in passing earlier, that we'll describe in some detail later on in the session. Now, in some cases, those securities are sold directly by issuers to investors. And note that in the exhibit here, I've referred to institutional investors, because the vast majority of fixed income securities are held at least directly by institutions. While individuals in many financial markets might account for a significant percent of the holding of equity securities, 10, 20, 30, in some economies maybe as much as 30 or 40% of the outstanding equity securities are owned by individuals, that's not the case of fixed income securities for a variety of reasons. One, the normal trading units are relatively large, 100,000 or more in many cases. So for most individuals to hold a diversified portfolio of fixed income securities would be extremely difficult. So consequently, probably well in excess of 90, maybe in excess of 95% of the direct holding of fixed income securities are by the various investing institutions. Mutual funds or other investment companies, pension or retirement funds or plans, asset managers investing money on behalf of either the wealthy or maybe pooled funds of the masses. But it's these institutions that do the bulk of trading and investing, at least directly in the fixed income securities, although of course many of these institutions are investing on behalf of individuals, but again the direct ownership is in the hands of the institution. Now, as I said before, in some cases, securities are being sold directly by the issuers to these institutional investors, but usually that's only government securities, or in some cases, firms that have the expertise in placing securities, financial firms like banks or investment banks. But for the vast majority of issuers, most corporations, the vast majority of regional and local governments, they're not significant enough issuers to be conducting issuances, we'll talk about auctions later on a regular basis. And so consequently, they don't have the in-house expertise or the wide enough demand to easily place all the securities on their own. So outside of major national governments, the vast majority of securities are sold not by the issuers directly to investors, but rather the issuers are selling those securities to financial firms that are going to act as underwriters. Now, usually there is a managing underwriter, or in some cases there are multiple managers, in which case one of them will be designated as the lead managing underwriter. But usually that managing underwriter is negotiating with the issuer over the terms of the offering, and if they can reach agreement, The issuer, the corporation, the local government, is selling securities not directly to investors but to the underwriter. And note, by the way, usually this is not the manager working on their own. Usually what they're going to do is put together an underwriting syndicate, where the syndicate is legally structured typically as a joint venture, a gathering of banks and brokerage firms for a particular project, that is the placement of these securities. And then, again, if agreement is reached, the securities will be sold by the issuer to this underwriting syndicate, and they're guaranteed a certain amount of money in most instances, regardless of whether the offering is successful or not. What I'm describing is what's typically referred to as a firm commitment underwriting. And it's called that because the underwriters are making a firm commitment to pay the issuer those promised monies, regardless of whether the distribution is successful or not. And so once that agreement is reached, under the rules and regulations of the market where they're operating, the underwriters will then attempt to turn around and sell those to investors. Some individual investors, but the vast majority of the sales will be to the institutions we talked about previously. But any of the unsold securities in such an offering will not be given back to the issuer. The underwriters will end up having to buy any securities they can't place with the issuer. And this is how the vast majority of underwritings are structured, as what, again, I referred to as fixed commitment underwritings. And then there's rules about how we'll allocate the unsold securities among the syndicate members, and a detailed discussion of that is beyond the scope of what we're going to talk about here. But these firm commitment underwritings account for the vast majority of securities placements. Now, there are also what are known as best efforts underwritings, where underwriters will make their best efforts to sell what they can, but anything they can't sell, they have no liability for, and any unsold securities are in that case returned to the issuer. They'll refer to that also as an agency arrangement, because the underwriter's not buying for their own account. They're not principals in the transaction. They're simply acting as the placing agent for the underwriters. But again, those sorts of best efforts underwritings are much less common than the firm commitment underwritings I'd mentioned just a moment ago. Now, let's go back to one of the initial questions we were talking about, which is, what is a bond? Well, in reality, a bond is really nothing more than a loan, but it's a loan that's been packaged in a way so as to make the transfer of ownership from the initial lender, which is what investors in fixed income securities are doing. They're in effect lending money to the issuer of those bonds at the time of the initial issuance. So a bond is really just a loan that's been packaged in a way so that that first investor, that first lender, can easily transfer the ownership to some other investor. Now, many of you might say, well, there's differences between bonds and loans. Well, we'll come back and talk about that issue, but think of some of the terminology related to both bonds and loans. Because, for instance, we've got an amount borrowed, which is typically referred to as the principal. Well, whether that money is borrowed by issuing a bond or taking a loan out from some lender, like a bank or a finance company, that principal ultimately has to be repaid. And of course, the borrower doesn't get the use of the funds for free. They have to compensate the lender or the investor for having the temporary use of the investor's funds. So consequently, the borrower will also owe interest on that principal for the amount of time the principal is outstanding. Well, the repayment of either loans or bonds can be structured a number of ways. The interest, of course, ultimately has to be paid on the principal for as long as it's outstanding. And then in addition to paying the interest on the outstanding principal, ultimately the principal itself has to be repaid. Well, how is the payment of interest and the repayment of principal going to be structured? Well, there's a variety of possibilities, but again, it's the same and the same terminology for both bonds and loans. Because the two general ways of returning principal, either it might be all returned at maturity. So if the terms of the bond or the loan is that all the principal is to be repaid at the date when the final payment is due, that's what's known as a term bond or a term loan. And again, term simply means all of the principal is due at the final term, at the terminus of the transaction, at the bond's ultimate maturity, when that final payment is due. The other possibility, of course, is that the principal might be payable over time. And so there's going to be some schedule according to which that principal has to be repaid. And when you have principal repaid over time, so that at the final payment date only a small portion of the original borrowing might be due, that's what's referred to as an amortizing loan or an amortizing bond. And in some market segments, that's actually fairly common. So for instance, the vast majority of mortgage loans are what they call amortizing loans because the terms of the contract for most mortgages specify the repayment of that principal over time. And similarly, just like the repayment of principal can be structured in one of two ways, the repayment of interest, or I should say the payment of interest, can also be structured in two ways. The principal might again be payable over time, and when it's payable over time as opposed to being all due at one date, then typically the payment is in the form of a periodic coupon payment. So there's a coupon rate which expresses the annual amount of interest as a percent of the principal. But it might be payable one time a year, twice a year, 4 times a year. There's different frequencies, and we'll talk about some of those frequencies and what's common in different market sectors. And of course, the other possibility is that all the principal is to be repaid at the ultimate maturity. And if there's no principal due before the ultimate maturity, the only structure where you encounter that is what's known as a zero coupon bond. In fact, in that sort of security, you only get a single cash flow at the ultimate maturity, and that final payment represents a return of all the monies borrowed, as well as the payment of all the interest that was due over the life of the security. Let's look in a little bit more detail at the similarity between bonds and loans and surface some of the terminology that in many cases is the same, although in some instances implies some slightly different meaning in the case of bonds versus loans. So many people mistakenly think that, oh, well, bonds and loans are distinctly different, but clearly much of the terminology is the same, so that there is someone who is obtaining funds through the transaction, whether it's a loan or a bond issue, although the terminology here is a little bit different, so that the party receiving funds on a loan is the borrower. The party receiving funds on the issuance of a bond is oftentimes referred to as the issuer. But why are they issuing bonds? In effect, to borrow money. So there's a difference in terminology, but no difference in substance. Now, naturally, for the party to obtain funds, somebody must be providing funds. Well, again, the terminology might be different. In the case of a loan, the lender is the provider of funds to the borrower. In the case of a bond, it's investors that are providing the funds, although maybe not directly to the issuer, as we talked about before. For many issuers outside of major national governments, they'll use underwriters to place the bonds on their behalf, but ultimately the bonds end up in the hands of the investors. But again, investor or lender are two different ways of saying the same thing, because the lender, in effect, is investing in the loan, which they collect interest on and ultimately hope to get the principal back. The investor is the same. They're hoping to receive interest, although usually it's in the form of periodic coupon payments, but also expect to get the principal returned at the stated maturities. So again, lender, investor, two different ways of basically saying the same thing. Investors in bonds are lending money to the issuer of the security. Lenders on loans are investing in the loan as long as they keep that loan on their books. Although, again, there is a difference we talked about before. Most loans are made directly between a borrower and a lender, although as we indicated previously, if the loan is big enough, the lender is likely to syndicate that loan to spread the credit risk around a number of other institutions, lending institutions. And again, bond issues, other than by governments, are usually made not directly by the issuer to the investors, but the issuer is selling the bonds to the syndicate. Although, again, the syndicate is normally acting as a middleman, not buying the bonds for investment purposes, simply buying to resell to investors and, in effect, make a spread between what they've promised to pay the issuer and what they hope to sell the bonds to investors for. Now, let's look at some related terminology as it relates to both bonds and loans. And again, the terms are different, although here we'll see some slight difference of meanings as well. Because let's consider the principal on a bond or a loan. Now, for a loan, a principal, in effect, is the amount borrowed. All right? And that amount borrowed has to be repaid, either at maturity if it's a term loan or over time if it's an amortizing loan. But if we're talking about bonds, the par value or principal amount doesn't have exactly the same meaning. Yes, clearly, the principal is the amount that the interest is payable on, the coupon rate times the amount of principal outstanding. And the principal is what has to be paid to the investors by the issuer to extinguish the debt, again, either at maturity if it's a term bond or over time if it's an amortizing bond. But when we're talking about bonds, the principal is only approximately equal to the amount borrowed. You might say, well, why is that? Well, it has to do with the sort of the technical aspects of bond issuance. Given that the way coupon rates are set, oftentimes coupon rates will be set at a level that's slightly different than the yield to maturity the market is demanding on bonds of that time to maturity and that credit rating or credit risk. Well, given the fact that the yield and the coupon rate don't exactly match, would mean that the bond will be issued at a price different from par. In fact, most bonds are not issued directly at their par value, but issued at a slight premium or more commonly a slight discount to par. Although things like zero coupon bonds will be issued at dramatic discounts to par if they have long enough maturities. So yes, on a bond, the principal is the amount that the coupon is, or the interest rate is payable on, and the principal is the amount that the issuer has to pay back to investors to extinguish the debt, but it's only approximately equal to the amount borrowed, again, because given the way coupons are set, the coupon rate is oftentimes at least slightly different from the market yield that is demanded on bonds of that maturity and that credit rating. Now, another aspect, of course, is the interest rate, and in that sense, the principal is the same for both bonds and loans. The coupon rate or on the bond or the interest rate on a loan is payable on the amount of principal outstanding, so that's not any different. And the repayment terms and the terminology they use, that's pretty much the same for bonds and loans. As we were indicating before, the principal might all be repaid at maturity, which is either a term loan on a loan or a term bond if it's a bond, or the principal might be repayable at some specified schedule over the life of the agreement, over the life of the loan. Means it's an amortizing loan, or over the life of the bond, it's an amortizing bond, although as we'll see there are some other bond structures that also result in repayment of principal over time. And that might be either in the form of a serial issue, which is fairly common in the U.S. municipal bond market, or in the case of a sinking fund issue. Now, from investors' perspective, it looks like a term security in the sense all the principal is repaid at once. But when you look at the structure of the entire issue, a portion of the issue is being retired over time. So from the issuer's perspective, it's a sort of amortization of that ultimate repayment of principal. So one of the issues as it relates to understanding value in the fixed income market is how do we come up with what a bond that is paying a coupon over time and returning principal at maturity say, how do we establish the value of that security and what's going to cause investors to view a bond as more or less attractive? Well, of course, one of the fundamental concepts of investing is that expected return should reflect the expected risks of the security. And realize risk, and we'll talk about specific types of risk later, but in effect, risk is uncertainty. So, or one of the ways we can think about risk as uncertainty. That is, what are the various features of the bond contract that causes our future returns to be uncertain? So consequently, when dealing with those uncertainties, and let's talk about some of those uncertainties that one might face, so that, for instance, when we're trying to value a bond and understand these risks or uncertainties, some of the factors that lead to uncertainties are the fact that we can't know with certainty the timing nor the amount of the cash flows, at least in many instances. Why might we not be aware of the timing or the amount of the cash flows? Well, some of the issues we talked about previously. In some cases, the repayment of the principal might be accelerated. That is, the borrower, the issuer, might have the ability to return some or all of the principal in advance of the scheduled time. Well, that introduces some uncertainty about the exact timing of the return of the principal. Or in some cases, the interest payments will change over time. Now, of course, where the coupon payments will change at a set schedule, well, that's not a cause of uncertainty. But where the coupon rate is not fixed in advance, we talked about floating rate or adjustable rate instruments. Well, that means that those coupon payments will be reset periodically, which causes us to be uncertain about what will be the amount of the interest we'll be earning period by period by period. And then, of course, one of the greatest uncertainties for many issuers anyway, is will they be able to pay all the interest and principal in full in a timely fashion? In other words, there's potential credit risk, also referred to as default risk, as we'll see later. Well, that consequently also causes us to be uncertain, not about when the payment is due, because there might be a fixed payment according to the contract. The issue is, will the borrower or the issuer be able to honor that contract, because there might be defaults or delinquencies. Well, how do we deal with those uncertainties? Well, the way you deal with those uncertainties is in a variety of ways, but the most common way is by taking either the contractual or the projected cash flows and trying to estimate their present value by discounting them by some interest rate. And so consequently, we will adjust the interest rate or discount rate we're using to value future cash flows depending upon the risk. So safer, lower risk investments will find their present value by discounting by a lower rate of interest. Conversely, where the risk or uncertainty is very high, we'll discount those future cash flows by a relatively high interest rate. Now, those discount rates in part reflect just the pure impact of time, and that's based on what's known as the real risk-free rate, i.e. Real meaning adjusted for inflation. Risk-free meaning it's a rate on some default risk-free security, like some government security from a reasonably creditworthy governmental borrower. And those would be the rate, and then adjusted for expected changes in the price level, of course, expected inflation. So those sorts of rates we'd use to value government securities. But when you're talking about non-government issues, you have to take other risks into account as well. And some of those relate to uncertainty about repayment, credit risk, or credit spreads, as we'll talk about later. Some of those relate to the ease or the difficulty of turning that investment into cash, what's known as liquidity risk. And then, as we'll also see, options that cause us to be uncertain about the ultimate maturity date, when maturity can be extended or shortened as a result of call or put options. That also introduces some uncertainty and would adjust the interest rate at which we're valuing those future cash flows.
Welcome to Introduction to Fixed Income Securities and Markets. In this activity, you will practice applying key concepts from this section. You will complete 5 steps over the next 60 minutes. Step 1 helps you identify real-life fixed income securities and their issuers. Step 2 focuses on classifying whether these securities were issued in the primary or secondary market. Step 3 guides you to simulate a bond issuance for a company raising funds. Step 4 asks you to compare bonds and loans across their key features. And finally, Step 5 helps you identify factors influencing bond valuation. Let's get started and apply what you've learned in a hands-on way.
Let's look at some of the terminology and the bond contract features they relate to in a bit more detail. So we've encountered a number of these words before, but let's dig in a little bit deeper. So if we're talking about the characteristics of fixed income securities, we need to focus first on the contract features. And I say contract because, in effect, most bond issues are based on some contract, sometimes called a trust indenture, but there's other names for it, that specifies the terms of the agreement between the borrower and the investor or lender. So we encountered principal before, but principal is also what's known as par value, also sometimes known as the face amount, sometimes principal amount. But those various words, par, par value, principal, principal amount, face amount, for the most part, they're completely interchangeable with one another. Of course, there's exceptions. If you're talking about amortizing securities like mortgage-backed securities, you have to be able to make a distinction between the original face amount and the current outstanding principal. So in some amortizing securities, the meaning of those words start diverging a little bit. But for the vast majority of securities, par, principal, and face amount or face value can be used pretty much interchangeably with one another. And of course, as we said before, the par or principal amount is the amount that the interest rate is payable on. But as we saw before, while principal means the amount borrowed with a loan, because of the way they set coupon rates, and I'll make a few further comments about that as we're talking about coupons in a few moments, but given the way coupon rates are set, oftentimes bonds are issued at a price slightly different than par. So for bonds, the par value is not exactly equal to the amount borrowed. It's usually similar to, or at least related to the amount borrowed, but slightly different. Now, of course, the issuer, we talked about the issuer previously. That's the party that's doing the issuance of the securities to raise funds. And the importance of the issuer is primarily with respect to how the market will view the credit risk of the issue. That is, do they view that the payments of interest and principal are likely to be made in full in a timely fashion? That would mean a high credit rating like AA or AAA. Or is there a fair degree of uncertainty about whether or not the interest and principal will be paid in full in a timely fashion? That would indicate a low credit rating, maybe a very low, lowly rated high yield security, something with a credit rating of maybe single B or triple C or something like that. And we'll talk about the credit ratings in some detail later on. And I don't mean to say that it's necessarily the issuer's financial condition, because as we'll see, there's other ways to enhance the creditworthiness. The issuer might pledge assets as collateral. They might buy some sort of insurance or some other sort of guarantee so that if the issuer can't repay the interest and principal, that some insurance or guarantee will kick in to make sure the payments are made to the investor in a timely fashion. But when you have those sorts of features, then the creditworthiness of the bond is not based on just the issuer's circumstances. It's also based on the financial worthiness of the insurer or guarantor. The other way the issuer will sometimes affect the security as well is in the liquidity of the issue, because some widely recognized names might see their bonds traded more actively, not necessarily because they're more attractive or because there's more of them out there, simply because investors feel they have a greater awareness, a greater familiarity, and that familiarity causes a higher degree of comfort and willingness to trade, consequently making the securities more liquid in some cases. The coupon rate is normally expressed as a % of the par value, so that let's make up a hypothetical bond quote here to illustrate some of these ideas. So let's say we saw a quote something like 100,000 XYZ 4.5 apostrophe S apostrophe, say 33 at maybe 92. Now, how would I interpret that? Well, it's 100,000 par of bonds from the infamous XYZ company as the issuer, carrying a 4.5% coupon rate, with the bonds maturing sometime in the year of 2033, in about 20 years. And the bond is trading at a % of par price of 92% of par. Well, looking at that coupon rate now, if the par value is 100,000 and the coupon rate is 4.5%, or 0.045 in decimal terms, if you multiply the decimal equivalent of the coupon rate times the par amount, that will give you the annual interest payments due from the issuer to the investors. So in this case, that would be $4,500 a year. How will it be paid out? Oh, well, now that depends on what is the compounding convention, because there's a variety of different compounding conventions. It might be a single annual coupon. That's the norm on the continent of Europe, for the most part anyway. And the Euro bond markets, that's the extra-national market for bonds. That is bonds being issued outside of the home country of that currency, well, the euro bond market, in other words, dollar bonds traded outside of the US, or sterling bonds traded outside of the UK, or euro-denominated bonds traded outside of the EMU area, well, those euro bonds follow the conventions of the European continent, single annual coupon. On the other hand, in many of the English-speaking countries, US, UK, Canada, etc., the norm is for interest to be payable twice a year. So consequently, while the annual interest due is $4,500 a year, the investors would expect to receive 2 semi-annual payments of $2,250 each. In some markets, quarterly is the norm. So I won't go there, but the point is that while the coupon rate times the par value gives you the annual amount of interest due on that security, the actual coupon payments will be a function of what's the annual payment due and over how many periods will that annual interest be paid out. And the common frequencies are annual, semi-annual, quarterly, and in some market segments even monthly. Now, another way that the coupons are important has to do with the initial pricing of the security as well as the pricing over the life of the bond. And we made a reference to one of those issues earlier. That is, why are most bonds not issued at par? Well, or at least many bonds not issued at par. In many markets or market segments, issuers follow a convention about the level that coupons will be set at. So in many markets, they follow a convention that coupon rates will only be expressed in 1/8% increments. So I had posited earlier a bond with a 4.5% coupon rate. Well, if the issuer and the issuers in the segment are following that convention, the next highest coupon rate would be 4 5/8. The next highest coupon rate above that would be 4 3/4. Or working down from 4.5, the next lower coupon rate would be 4 3/8. The coupon rate below that would be 4 1/4. Right. So I'm not saying that all market segments follow that convention, but many market segments do. Well, what happens then if you're in such a market segment that follows that convention and the market rate of interest, and by market rate of interest I mean the yield to maturity the market is demanding for bonds of that maturity and that credit rating. Well, let's say the market rate of interest, as I just defined it, in this market segment is, say, 4.55%. Well, you'll note that market rate doesn't fall exactly on any of these 1/8 of a point increments. Now, in some market segments, they will set coupon rates at any level, and in other words, they're not following that convention. And if I can set coupon rates at any level, if that's the market rate of interest and I set my coupon rate at 4.55%, that means that bond could be sold at its par value. But if I'm in a market segment where we're following this convention of bond coupon rates only being set on 1/8 of a point increments, then we can't set the coupon at 4.55%. So consequently, if, say, the market rate of interest is what I posited a moment ago at 4.55%, and we're following this 1/8 of a point convention, the normal process is to set the bond coupon at the next lowest increment. And since now the coupon rate is below the market rate of interest, you'd end up having to set that bond price at a discount to par, say maybe 98.5% of par. But that's why most bonds are not issued at or at least many bonds are not issued exactly at the par value. It's because you're in a market segment or an issuer that's following that coupon setting convention, and consequently in many instances the market rate will not be exactly equal to any one of those normal increments, and so consequently you'll have bonds issued at a price slightly different from their par value. And then the final issue to talk about here is the maturity date. Maturity date, again, is the date when the final payment is due, both the final payment of principal, all of the principal if it's a term bond, or the final amortization of principal if it's an amortizing security, as well as the final interest payment, the last coupon that's due on the amount of principal outstanding. All of it if it's a term, again, the remaining little bit of principal if it's an amortizing security. And remember, I'd mentioned serial bonds before. Serial bonds are bonds issued at one time, but then portions of the issue will mature gradually over the life of the issue. So from investors' perspective, they're getting all their principal back at the same time, but from the issuer's perspective, they're retiring a portion of the issue year in, year out over the life of the security. So again, it looks a little bit different depending upon whether you're the issuer or the investor. In many of these, again, the investor is getting a full return of the principal that they have coming at one moment in time. But since the issuer is paying off different investors at different maturities, from the issuer's perspective, it's an amortizing security. Let's look at some of the aspects of the coupon rate and variations in coupon rates that we'll encounter on fixed income securities. So some of this is a review, but just to make sure we cover it in adequate detail. Bond coupons, remember, could be either be payable over time, and if they're payable over time, that means it's in the form of a periodic coupon. And again, that frequency could be annual, semi-annual, quarterly, or monthly. And that's going to be dictated by the market in which the security is issued, what is the norm, as well as the market segment. Because even in one national market, like the US market, you'll see all of those different frequencies, annual, semi-annual, monthly, and quarterly, on different types of investments. And the other possibility, of course, is that none of the interest is payable prior to the ultimate maturity, and that's on a zero coupon bond, because on a zero coupon bond, sometimes called a strip, and we'll talk about government or treasury strips later, on those sorts of securities, the investor is receiving only a single cash flow at the ultimate maturity of the investment, and that single cash flow, while it's the face value of the investment, that single cash flow represents a return of the investment as well as all of the interest that was earned on that investment over the life of the security. Now, while bonds can have either of those payment of interest features over time or all at maturity, within the coupons that are payable over time, you see a variety of different structures. So those periodic coupons might be fixed, they might be constant over the life of the investment, or as we said before, they might be floating coupon rates or adjustable rate investments. That means the interest rate will reset periodically. And just like bonds, when they have fixed coupons, can have those coupons payable at different frequencies, the same thing applies to the adjustment of adjustable rate securities or floating rate instruments. So the rate might reset annually or semi-annually or quarterly or monthly or at other frequencies, but those four are probably the most common as well. And any time you have a security that resets, there is going to be a coupon formula where that coupon is going to be based on some index rate. An index rate is just a generic reference to some widely available, at least usually widely available, market rate. So it's visible to many market participants and will simply reset at whatever the stated frequency is, annually, quarterly, or whatever, according to that index rate. And usually the securities are not going to carry a coupon that's the index rate flat. It's usually the index rate either plus or minus some differential. And by the way, most corporate borrowers will have to play the index rate plus a differential. In some cases, very creditworthy governments can borrow at that index rate minus some differential. And by far, in today's market environment, one of the most common index rates is LIBOR, where LIBOR is an acronym. And that LIBOR stands for London Interbank Offered Rate. So it turns out this is simply the rate on currency deposits that banks in the London interbank market will trade these deposits in extranational currencies. So these are dollars outside of the US, or franc outside of Switzerland, or yen outside of Japan. So this is not the only index rate by far, but it is probably the most widely used index rate in the vast majority of segments in the fixed income markets today. And then you can have a variation in fixed coupons, but it's not a constant coupon rate over time. Rather, it will be fixed for some period of time, but then it will adjust. They'll sometimes refer to these as split rate coupons. So it's not like an adjustable rate that will be adjusting periodically according to movements in some index rate, but rather the coupon rate is changing at a specified level. And most of the time, these are step-up coupons where the coupon rate will be adjusted according to some event or according to some calendar, but there is a pre-specified schedule that will state the way in which those fixed coupons will change over time. Now, another thing we'd like to talk about is the pricing of bonds. And you might remember in the example I gave of a bond quotation sometime previously that the final element in that hypothetical bond quote was the @ symbol 92. Bond pricing is usually done so as to express the value of the bond either in currency units, dollars or yen or euro or franc as the case may be. But while you can express it in terms of a specific number of currency units, oftentimes bond values are expressed as a % of the par value. So if I had a par value of 100,000, and that security was quoted at 92, that is 92% of par, that would imply a market price of $92,000. Right? So that's just the % of par implication in terms of the specific unit currency price, given I've got a % of par quote of 92 and a par value of 100,000. And that price is normally expressed as a value of the security that doesn't reflect the full value, because you'll note I referred to this as the market price. You might say, well, what could the bond be worth if it's not worth its market price? Remember the periodic coupons we talked about previously. So since the coupons are only paid at discrete intervals, what happens if we trade a bond in between coupon payment dates? Well, if we trade a bond in between coupon payment dates, that means that some portion of the next due coupon was actually earned by the seller of the security. But the convention in the market is for whoever owns the bond on the coupon payment date receives the entirety of the coupon. So consequently, while that price, as I'm talking about it, this is the market price, that reflects the present value of the future cash flows, remember that there has to be a compensation to the seller of what portion of the next due coupon was earned from the last coupon payment date up until the settlement date of the trade. So market conventions are for the full value of the bond to reflect not only the market price, which, by the way, is also referred to as the clean price or the flat price. For most bonds, that doesn't reflect the full value of the bond, because that would ignore that coupon issue that we talked about previously. So the market convention for trading bonds is that bonds are quoted flat. That is, bonds are quoted by the market price, but they are said to trade with interest. In other words, when we settle the trade, when the buyer and seller exchange the ownership of the securities for the money the seller receives will be not just the market price, but they will earn along with or receive along with the market price the accrued interest on the bond. Or accrued interest is the formal name of that issue I was talking about before. That is, again, when a bond trade is made between coupon payment dates, the seller receives not only the agreed upon price the buyer and seller have negotiated, but they'll also fall back on industry conventions to determine how we'll account for how much time lapsed from the last coupon payment date up until the settlement date of the trade. And the seller will expect to receive the portion of the next due coupon that was earned from the last coupon payment date up until the settlement date of the trade. So that is by far the most common convention for pricing bonds in most financial markets around the world. That is, we'll quote the bond by its market price, but we'll presume that in addition to the market price that the bond was quoted at or the buyer and seller agreed to, there'll be industry conventions we'll fall back on to determine how much interest will be added to that market price. And again, that's what portion of the next due coupon had been earned from the last coupon payment date up until the settlement date of this trade that occurred between coupon payment dates. And while a detailed discussion of the process for computing that accrued interest is something we'll not go into in depth right here, you should be aware of some of the complexities that enter into the coming up with those numbers. Because I've said that they'll fall back on industry standard conventions when determining how much of the next due coupon was earned from the last coupon payment date up until the settlement date of the trade. Well, there's different ways for accounting for the passage of time. And some of the more common, and these by far are not the only ones, or maybe I shouldn't say it that way, there's variations of each of these without getting into it in too much depth. But the widely used day count conventions are either 3360, that is, we'll assume every month has 30 days, and if you have a year of 12 30-day months, that's a 360-day year. Well, that's the norm in most of the continent of Europe. It's also the convention used in the corporate and municipal and government agency market sectors in the United States. On the other hand, there's actual over 360. That is, we'll use the actual number of calendar days over which we're computing the interest earned, but we'll still assume a 360-day year. Now, of course, that 360-day year was used. Why? Well, in the eras before calculators and computers, 360 was a much easier number to divide by than 365. Ergo, those simplifying day counts. You might say, well, now we have computers and calculators. Why do we need to fall back on those arbitrary simplifications? Well, it turns out that there's no ideal day count convention, and each of them has their quirks. So the market segments used to using those can continue using them excuse me, without a problem. But there are other day count conventions as well. There is actual over 365. Again, we'll count the actual number of calendar days, but now we'll assume the right length of the year. It's called actual over 365, but if it's a leap year, they'll use 366. But then there's even something where you'll use actual days. Now, many people think those are two different ways of saying the same thing, but without going to the technicalities of the two, it actually turns out they're a little bit different. Well, let's look in a little bit of detail at some of those day count conventions we were just talking about. Specifically, in what market sectors do they use one or the other of those day count approaches, and even an application, how the day counts are used to calculate the accrued interest we talked about previously. So here you see a slide that tries to illustrate some of the variations in day count conventions in money markets around the world. And remember our discussion of money markets previously. Money markets are the markets where you have the issuance of short-dated debt securities, i.e. generally those with a year or less to maturity from the date of issuance. And you can see, even if we restrict ourselves to talking about only money markets, there's a variety of different day count conventions used in different parts of the world. So some market sectors use actual over 360. I haven't got the U.S. up there, but it could be added to that list for at least the money market segment of its fixed income markets. But many markets also, that is many national markets, also use actual over 365 as the day count convention for that same class of securities. And you also see at the bottom here some of the illustrations of the compounding frequencies used in different market segments. So I've illustrated the fact that in some major markets, annual compounding is the norm. On the other hand, in many markets, semi-annual compounding is the norm. In fact, I haven't got it up here, but in some markets, quarterly is actually the normal frequency for coupon payments. Now here we see more detail on the day count and compounding conventions in various segments of the U.S. fixed income markets. So here we're looking at just a single national market, and yet nonetheless within that national market we see a lot of variation. So that 3360 Remember, we talked about this previously. We're assuming every month has 30 days length, and a year of 12 30-day months is a 360-day year. If you ever encounter the phrase commercial year in the context of a fixed income security, what's a code phrase for saying they use a 30-360-day count convention? But other market sectors use actual over 360, the money markets we talked about previously, and Treasury securities use actual days. And again, when it comes to compounding, you see a wide variety of compounding frequencies for different dollar-denominated securities. In the domestic market, annual compounding is very uncommon, but the dollar bonds issued outside of the United States use annual compounding typically. But semi-annual is the norm for many market sectors, but quarterly, especially in the case of fixed income related derivatives or floating rate notes, and even monthly for mortgage-backed securities. So there's a wide variation there. Now, I'm not going to work through these examples in detail. They're there for the motivated student to work through on their own if they would really like to roll up their sleeves and dig into the accrued interest issues we talked about previously, but to talk about these examples conceptually at least. So across the top of the exhibit, I have a description of a hypothetical bond issue. And since it's a corporate bond issue in the U.S., it uses the 30-360-day count convention. And you'll note that what is also given up here are the coupon payment dates of January and July 15th. And this exhibit was put together back in May of this year, 21st of May of 2013. Well, of course, a trade occurring on May 21st, that's the day the buyer and seller agreed to do the trade, doesn't settle immediately. In the U.S. corporate bond market, trade settled T+3. That is, the trade settles on the third business day after the trade date. So since the 21st was, I believe, a Tuesday, the trade was going to settle on the following Friday, 3 business days later. And remember, it's the settlement date that's the significant date with respect to who is the party that's earning the accrued interest. Because it's going to be the seller that earns the accrued interest that is earned starting on the coupon payment date, the last coupon payment date, and running up to but not including the settlement date of the trade. So that portion of the next due coupon, in effect, has been earned by the seller. On the other hand, the buyer, who is the owner from the beneficial, I should say the beneficial owner from the settlement date forward, the buyer is the party that, in effect, is earning the interest that's earned from the settlement date forward up until the next coupon payment date. So that's the buyer's share of the next due coupon. But remember, as we'd said previously, whoever owns the bond as of the coupon date receives the entire coupon. That's why the buyer has to pay the seller not only the price they've agreed on, but also the amount of the accrued interest. That is, what portion of that next due coupon of $23.75 would have been earned by the seller, again, starting on the last coupon payment date and running up until the settlement date of the trade. So here you see the day count if the trade was done for a security that used a 30-360-day count convention. And then the numbers from the example are plugged into the appropriate formula to calculate the amount of the accrued interest. And so what the buyer pays the seller is not simply the agreed upon price, so the 95% of par, 95% of 100,000, means that the market price reflected by that percent of par quote is 95,000. But the seller is going to receive not only the market price, they're also going to receive the accrued interest. The 23.75, or I should say the portion of the 23.75 that was earned starting on the last coupon payment date up until the settlement date of the trade, that accrued interest being 1702, that interest being 1702.08. So consequently, the amount of money the buyer actually has to deliver to the seller is going to be, in this case, $96,702.08. That's the full value of the security, what's also known as the dirty price of the security. here you see another example with the same basic setup, except now the presumption is that it's a U.S. Treasury security that's being traded. So the numbers are going to work out a little bit differently for a variety of reasons. One is that Treasuries settle T+1, the business day after the trade date. And also the day count is different because now, since that's a Treasury security, what you need to use is actual days. And so you'll note the day count is done a little bit differently. In fact, we have to count more than just the days of accrued interest. Since it's actual days, we also have to know the actual number of days in the coupon period, because you'll note the formula for computing the dollar amount of the accrued interest is a little bit different. So conceptually the same, but because of a different day count convention and a different time frame to settlement, the dollar amount of accrued interest is going to be fairly significantly different. Now, some of the other characteristics of fixed income securities that were alluded to in passing without directly addressing them, and that has to do with the potential early retirement of a bond, that is, a bond being retired before its stated maturity date. And so the circumstances that could result in a bond being retired early would typically relate to either the fact that the bond is callable, or the fact that there's a sinking fund provision in the bond, or, not very commonly, but occasionally, you'll see a puttable bond. Now, the differences between call provisions, again, are provisions of the bond contract. You'll note that the bottom line on this exhibit makes a reference to trust indentures. I talked about those earlier in the session. Those are that's the way you describe in many economies the contract between the bond issuer and the bond investors. And that contract is going to state all the legal obligations the issuer has to observe, what are the rights of the bondholders, appoints a trustee to watch out for the interests of the bondholders. That is, making sure the issuer honors the terms of the contract itself. All right, well, any of these provisions, call provisions, sinking fund provisions, put provisions, would be provisions written into that contract, clauses in that contract. So if a bond is callable, the trust indenture will include a call provision that specifies the terms under which the bond might be retired early, i.e. the bond might be called. Now, it's possible that there might be some sort of mandatory call triggered by some event, but the vast majority of calls are at the issuer's option. And the call provision then will have to specify what's the earliest date the bond could be called, what they call the first call date. And some bonds are callable immediately after issuance, but that's also very uncommon. Normally, there's a certain amount of call protection. Call protection, simply the period of time between issuance and the earliest time the issuer could return the bond. And what's norm varies from market segment to market segment, but it's typical in some market segments the first call date might be 2 or 3 years after issuance, or in other market segments it might be 5 or 7 or 10 years after issuance. And also, a call is something that works to the issuer's advantage, not to the investor's advantage. So consequently, to some extent compensate the investors for the fact that the bond might be taken away from them, not at their behest, but at the issuer's option, well, most callable bonds will include a call premium. That is an amount above the par value that the issuer has to pay to the investor to retire the bond early. And most bond contracts will specify a call schedule. And the phrase call schedule might sound a little bit misleading because it's not the schedule according to which the bonds will be retired. Rather, it's the schedule of call premiums that are going to be paid depending upon when the bond is called or retired. Sinking funds, on the other hand, are contract terms, trust indenture terms, that require the issuer to retire some portion of the bond issue at some stated schedule prior to maturity. Now, they're not retiring specific bonds. They're retiring either through secondary market purchases or at random calls. They're retiring bonds from investors, again, either in the secondary market or chosen through an at-random call selection process. Reason for a sinking fund: it reduces investors' concerns about default risk because the issuer is on a budget. They're retiring some portion of the issue prior to the stated maturity date. And finally, the put provisions, which are very uncommon, but put provisions are the reverse of a call, where a call gives the issuer the right to retire a bond early. A put provision gives the investor the right to put the bond back to the issuer, that is, force the issuer to buy the bond back. So whereas calls work against the investor's best interest, in effect, as we'll see later, calls place an effective ceiling on how high a bond is likely to appreciate, put provisions work to the investor's benefit. In effect, they'll establish a floor below which the bond price shouldn't fall, of course, unless the issuer is encountering financial difficulties. Let's turn to a consideration of expected returns and risk factors as they affect fixed income securities. So what we're going to go through are some of the more common risks encountered by investors in fixed income securities. Obviously, the potential list is much longer. Something we won't talk about, for instance, legislative risk. In other words, the legislature can change the laws as it affects securities trading or issuance or taxation. But those sorts of changes are hard to predict and relatively infrequent. So what we want to focus on are the more common risk factors that are faced by investors in most fixed income securities across most time. So here you see a list of some of the more commonly encountered sorts of risk. And starting from the top here, we have credit or default risk, which I had referred to in passing sometime previously. And credit or default risk, and those phrases are completely interchangeable with one another to most financial market participants, that is simply a reference to what are the expectations about the issuer's ability to service the debt in a timely fashion. Debt service meaning paying of interest and principal as it comes due, or making a sinking fund retirement according to schedule. Well, of course, the credit or default risk is the type of risk that is analyzed and evaluated by the credit rating agencies. Credit rating agencies are organizations like Standard & Poor's, also known as S&P, or Moody's. Short for Moody's Investor Services. And there's many others, Duff and Phelps, Fitch's. But Standard & Poor's and Moody's account for the vast majority of the credit ratings. And most people are familiar with the ratings in general, the highest rating being AAA, although AAA has a somewhat different look depending upon whether you're getting a AAA from Moody's and Standard & Poor's. And the ratings go down from there, of course, that being the very highest credit rating. And in the case of Standard & Poor's, the credit ratings run all the way down to single D for bonds currently in default. And we'll look at credit ratings in a little bit more detail later on. But these rating agencies are trying to give some assessment of that credit risk, that is the certainty or greater or lesser certainty of the likelihood that the debt service will be paid in full in a timely fashion. AAA rating, oh, you're thinking that there's very little doubt the issuer will be able to pay off the debt in a timely fashion. And of course, the investment grade ratings run all the way down to BBB minus in the case of Standard & Poor's, or Baa-3 or Baa3 in the case of Moody's. So anything with that rating or higher is what we would consider investment grade. Anything with a rating that falls below the investment grade level, well, commonly that's what people nowadays will refer to high yield securities. At least that's the financial market's preferred way of referring to them. Or in some cases, the financial press prefers the more inflammatory language of junk bonds. But understand that phrase, junk bonds, is just a name because guess what market sector tends to generate the highest returns over protracted periods of time? Well, it's these things called junk bonds, as a matter of fact. So obviously, credit risk is a significant issue, primarily driven by the market's perception of the issuer's financial worthiness, its ability to generate revenue or raise funds by selling assets or selling securities. Again, unless, of course, there's some sort of credit enhancement in the form of a guarantee or some sort of bond insurance being acquired. Now, there's also what many analysts or investors refer to as interest rate risk, Although, as we'll see later, several sources of return are affected by changing interest rates. So what most market participants refer to as interest rate risk, if we wanted to be more precise, we'd refer to that as market or price risk. In other words, how interest rate changes affect the market price of the security. Now, while most investors, when they use the phrase interest rate risk, they are specifically referring to that price risk. Changing interest rates will also have an impact on the reinvestment return. That is the return we make by reinvesting the cash flows we receive over the life of the investment. So clearly that's associated with interest rate changes as well, because as interest rates move up or down, that affects the rate at which we can reinvest the cash flows received over the life of the investment, be they periodic coupon payments or, for that matter, amortization of principal. And the factors that affect those two, well, in the case of the price risk, that is the sensitivity of price to a change in interest rates, that's primarily driven by the time to maturity. Although in addition to that, the coupon has something of an impact. We'll talk briefly about bond price sensitivity in terms of duration and convexity, although that's not a primary focus of this discussion. But nonetheless, coupon does have an impact. But clearly the biggest impact on how sensitive a bond's price is to a change in interest rates is the time to maturity. Generally, short maturity bonds will have a price very insensitive to an interest rate change, whereas very long maturity bonds will have a price that's very sensitive to an interest rate change. And if we're talking about reinvestment risk, again, the uncertainty about the return we'll get from reinvesting the cash flows received over the life of the investment, well, of course, that's a function of how much cash we have to reinvest over the life of the investment. So for term securities, the reinvestment risk is completely a function of the coupon. Zero coupon bonds have no reinvestment risk over the life of the security. On the other hand, high coupon bonds give you lots of money that you'll have to reinvest over the life of the investment at uncertain future interest rates. So reinvestment risk is positively correlated with the coupon rate. High coupon bonds, high reinvestment risk. Low coupon bonds, low reinvestment risk. Zero coupon bonds, no reinvestment risk over the life of the security. And again, remember, amortizing securities, because the returning principal prior to the ultimate maturity, that's also going to exacerbate or increase the amount of reinvestment risk you're facing. Now, purchasing power risk speaks to the uncertainty about what you'll be able to acquire with the money you're collecting from your fixed income investment. Because even if the issuer makes its debt service payments in full, that is, they pay all interest and principal in full in a timely fashion, so I got all the money according to the contract, but I still don't know what I'll be able to buy with it because I can't be sure how the price level is likely to have changed over time. So many people associate purchasing power risk with inflation risk, because generally that's what causes the uncertainty of price, is how rapidly or slowly will prices increase over time. Of course, anyone who has lived in Japan in the last couple of decades is aware that sometimes you have negative inflation, in other words, more commonly called deflation. So that's why we're going to call this purchasing power risk as opposed to just inflation risk, because price levels can change in either direction. And clearly, the more rapid the rise in the price level, the more rapidly the purchasing power of the currency you're getting paid for holding that bond, the more rapid inflation is increasing, the more rapidly the purchasing power of those monies is eroding. So inflation is inversely related with bond values. High inflation tends to cause bond values to decline. Low inflation will tend to cause bonds to appreciate in value. And finally, liquidity risk. Liquidity risk is a reference to the ability to turn an investment into cash. Although typically it's more than just the ability to turn an investment into cash. So if we want, we could say that liquidity risk has three components. It's the ability to turn the bond into money. So that's turn the bond into cash, which you could do, of course, by selling the bond to some other investors. But beyond just turning the investment into cash, because if I'm willing to take a big discount from fair value, I could sell any security almost immediately. It's just that in some cases I might have to accept 80 or 50 or maybe only 20% of fair value. So consequently, another element for a bond to be considered liquid is there's a certain immediacy In other words, you're able to turn this bond into cash relatively rapidly and at a price that reflects the security's fair value or something close to the security's fair value. So really, all three of those elements have to be present for a security to be considered liquid. So bonds of the major national governments, bonds issued by the German government or the US Treasury or the UK Treasury or the Japanese government, all of those are highly liquid securities. Investment grade corporates, well, usually upper investment grade corporates are fairly liquid, although in periods of high financial stress like the fall of 2008, even upper investment grade securities will not be particularly liquid. On the other hand, things like lowly rated high yield securities, oftentimes they're relatively illiquid. So liquidity risk is just that flip side of liquidity. That is, the less liquid the security is, the more liquidity risk you're facing. And in general, the higher any of these risks, the higher the yield to maturity at which the bond must be trading, because in general, higher yields are associated with higher rates of return, and investors have to be compensated with high expected returns if they're facing high levels of risk. If these risks are relatively muted, that means investors would be willing to accept the bond at a lower yield. Let's consider the sources of return to investors in fixed income securities. And I'm not talking about return in high concept, like you're compensated for bearing credit risk or you're compensated for bearing interest rate risk. No, I mean in a much more mechanical sense. When we compute the return over some time period, some quarter, some year, what determines whether we had a positive or negative return and the size of the positive or negative return, a 3.52% positive return, a 7.18% negative return, a 12.7% positive return? Well, if we're trying to compute mechanically what the rate of return was, the sources of return could be broken down broadly into three major categories. Specifically, we could say the returns to a bond investor are a function of changes in the price of their security holdings, cash flows they're receiving from those holdings, and the reinvestment income on the cash flows received and reinvested over that time horizon. And all three of those components are important, although their relative importance varies depending upon the type of security and the length of your investment horizon and so forth. And one good thing to remember is most bonds are held not individually, but rather as parts of larger portfolios. And understanding that that's the way bond investments are held will help understand a variety of aspects of the fixed income markets. And let's actually start with the middle of the three that I talked about, cash flows coming from the investments. Well, again, remembering that bonds are usually held as parts of a portfolio. Oftentimes, basic books miss that, and the authors will mistakenly try to say, well, let me put this in the context of the reader and they can understand it better. And they talk about an individual holding a single bond. Well, of course, if I hold a single non-amortizing security, then the only cash flow I'm receiving are the interest payments or the periodic coupon payments. And therefore, those would be the cash flows I receive during the holding period of the bond. Of course, there are amortizers, which mean you might be collecting some principal period by period by period, even on a single bond. And when thinking about bonds the way they're really held as parts of large portfolios, well, in a large portfolio in any significant time period, like a month or a quarter, invariably in a large portfolio you're going to be collecting some principal, either because some of your holdings are amortizers, or because some of the bonds you held were called, or maybe some of the bonds you held matured. So that means a broader perspective on cash flows that affect our returns would be not only the periodic interest payments we're receiving, but also any principal we've collected, again because of amortizers or called or matured bonds. Now, in addition to those cash flows, a significant portion of return, especially over time, is the reinvestment income. Where's the reinvestment income come from? Well, the cash flows you receive, you're reinvesting those as rapidly as possible. So again, many basic book writers, well-intended of course, but mistakenly will talk about the bond investor holding that one bond using the coupons to supplement their income or retirement benefits or whatever. again, most bonds are held by institutions, and institutions reinvest the money as rapidly as possible. Even if they have to send out a check tomorrow, the money they get today, they'll reinvest in the overnight market. So especially over long time horizons, that reinvestment income can be a significant component of return. But especially if you're measuring return over short time horizons, and most professional fixed income portfolio managers will be assessed on a quarter-by-quarter, year-by-year basis. Well, over any such short period of time, it's likely that changes in price will account for the biggest portion of the return in that particular time period. And normally when people think about bond prices changing, they think about, oh, bond prices and interest rates, most specifically a bond's price and its yield to maturity. It's that specific interest rate. Well, bond prices and their yields will move inversely from one another. Yields going up means the bond price is falling. Yields falling, interest rates falling, the bond price is rising. And I'm not going to tell you that's wrong, but let's look at it in a more comprehensive fashion. Because we could probably break the elements of that price change down into three components. One component is changes in the base interest rates that market sector is pricing off of. In most large developed economies, and even in the emerging markets, the government bond market is the largest fixed income market sector, and most other sectors of the market will price off that government bond sector. So for instance, in the US market, most other fixed income market sectors price off the Treasury yield curve. On the other hand, in the EMU, Economic and Monetary Union, the 20-plus countries in around Europe that have adopted the euro as their national currency, well, in that case, there is no EMU-wide government bond market. Each individual country has their own separate bond market. So in some areas like the EMU, the base interest rates are oftentimes going to be the LIBOR swap yield curve. That'll be the base interest rate that other market sectors price off of. But then in addition to the change in those base rates, not all market sectors will move in perfect lockstep with one another. In other words, there are likely to be changes in sector or credit spreads. In other words, the spread between the AAA yield curve and the Treasury yield curve can widen or narrow. Or the spread between the Treasury curve and the BB yield curve can widen or narrow. So usually we're thinking of different credit sectors, although this also applies to issuer sectors. Because, for instance, in mortgage-backed securities, Ginnie Mae's, Government National Mortgage Association mortgage-backed securities, are backed by the full faith and credit of the U.S. government, the same guarantee that stands behind Treasury securities. So both of those groups, Treasuries, U.S. Treasuries, and Ginnie Mae's, have exactly the same credit risk. Nonetheless, those sectors will trade at dramatically different yields, primarily because of the embedded options in the mortgage-backed securities. But I'm trying to make the distinction there. That's different issuer sectors, and the spreads between Ginnie Mae's and Treasuries will widen and narrow. But then in addition to base interest rates and those sector or credit spreads, you also have to consider what sort of embedded options, what sort of embedded put options possibly, but the real big issue here are embedded call options, or the right of the lenders whose loans have been securitized to prepay those loans. So all three of those factors will enter into how a bond's price is affected by change in interest rates, and we clearly have to have a sense of that to get to measure our overall returns. Now, one of the ways of expressing insights in the bonds as investments is to talk about the yields at which the bonds are trading, or various types of yields. And we'll talk about a number of common yields and look at their computation briefly. So commonly encountered yields are things like the nominal yield. And understand nominal yield is fairly straightforward. Nominal yield is just a complicated way of saying coupon rate. So I guess one could sound sophisticated by saying nominal yield rather than coupon rate. On the other hand, there's also a current yield. Now this measures a portion of the return. If we wanted to calculate the current yield are the annual coupon payments. I'll simply call that the annual coupons. But by that, I mean the amount of the annual coupon payments, so the coupon rate times the par value, in other words. And you'll take those annual coupons and divide that by the market price. All right. So we're looking at only a single component of return. In other words, we're ignoring reinvestment income and price changes, simply relating the income we're getting from the bond itself to what we would have to pay today to get that much income. Because by paying the price today, I could receive the annual coupons going forward. The formula for yield to maturity and yield to call are very much broader than a simple calculation like that, so I will not try to write the formulas out here. We'll see the formula for those computations in just a couple of exhibits. But it's very important to realize that the word yield is not subject to an easy, relatively straightforward interpretation. In fact, let's consider the number of possible interpretations of yield. So consequently, while most of the time yield will have a specific meaning, the specific meaning will vary by the context in which it's used. When the word yield is used by itself, it is simply oftentimes a reference to a rate of return. What yield did you earn over the last year or the last quarter? On the other hand, the word yield might be generally a reference to some interest rate. Remember, all the interest rates on the previous page had the word yield in them. And there's many other interest rates that have the word yield in them. Yield to worst, yield to call, yield to par option, and a number of others I won't bore you with right here. But in some cases, when someone uses the word yield, it's simply a reference to one of those interest rates. On the other hand, yield might be a reference to the cash flows collected from an investment. You'll sometimes hear portfolio managers on CNBC or Bloomberg Financial Network talking about buying high dividend stocks. I know we're talking about fixed income here, but interest rates have been so low. Many bond managers have been going into high dividend paying stocks, and they'll talk about buying those high dividend paying stocks for the yield on them while they're waiting for the price to appreciate. That's clearly a reference to the dividend income from holding that security, that stock. Or in some cases, you'll hear bond portfolio managers say they're buying the bond for its yield. Well, what do you get from a bond? The cash flows you collect on the security. So sometimes the word yield is simply a reference to those cash flows. And note, many securities can be quoted by a yield to maturity. So yield in that sense can also be an expression of the current value of the security. In fact, if we want to be technically precise, that's the only technically precise meaning of yield to maturity. As much as most basic books define yield to maturity as the rate of return to an investor who buys a bond and holds it to maturity, remember what I'd said earlier when we encountered that idea before. That is that on most bonds, they do pay periodic coupons, as well as there being many amortizing securities. And that means your rate of return to maturity would be dependent upon the reinvestment rate. That is the rate at which you reinvested those cash flows, the coupon payments or amortized principal. And so consequently, if you can't know the rate at which you're reinvesting those cash flows, how could you possibly know your rate of return to maturity? So that's why I say the only technically precise meaning of yield to maturity is it's a way of expressing the current value of the security. So one of the complications when you hear someone in the financial markets use the word yield is which of these many meanings are they referring to when they use the word yield? And unfortunately, many times the speakers are running these various ideas together and they haven't sorted them clearly out in their own mind. But I would contend that yield is one of the most highly confusing words used in the financial markets because it has so many diverse meanings. So one of the complications when you're communicating with fixed income professionals is figuring out which of the specific meanings they're implying anytime they use that word yield. Here you see an illustration of calculations of some of the yields we were talking about several pages previously. So across the top there, you see the calculation of the nominal yield. And by the way, all these calculations are done for a bond with these terms: 10 years to maturity, 4 3/4% coupon rate, trading at 95% of par, and having a 100,000 par value. Well, remember, the nominal yield is just the coupon rate, so we don't really have to calculate it if we have the bond's description. But if you had to calculate it, if you take the annual coupon payments and divide by the par value, you get the nominal yield. Well, of course, that reasoning is very circular, because how do you get the amount of the annual coupon payments? Well, by multiplying the coupon rate times the par value. So you really don't need to calculate the nominal yield if you have the bond's description, because again, the coupon rate tells you the nominal yield. Or if it's preferred stocks, a type of corporate income security, fixed income security we'll talk about later, the nominal yield would be the anticipated dividend rate, as we'll see later. Now, current yield is a very straightforward calculation as well, but as a measure of return it's quite wanting, but the calculation is very straightforward. You take those same annual coupon payments, but now we're dividing by the market price, because the intent here is to get the income you're receiving per year as a percent of what you'd have to pay to get that income. So we can see that this bond has a 5% current yield. But again, as a measure of return, which many people mistakenly think yield is primarily a reference to, well, it's very wanting, because it only captures one element of return, the cash flows paid from the bond itself, the coupon payments, in other words. So it misses any reinvestment income. It clearly misses changes in price. So this is not really a widely used statistic in most segments of the fixed income markets. Oh yes, in those sectors where buy and hold is the norm, like say municipal bonds purchased by individual investors in the United States, oh, that's a telling statistic, because those securities are relatively illiquid, and you lose some of the tax benefits, or at least you encounter possible tax consequences if you sell early. So most municipal bonds purchased by individual investors are held for that tax-exempt cash flow. So in some market sector like that, where buy and hold is the norm, current yield is somewhat telling. But for most sectors of the taxable bond market, there is at least some degree of trading by most institutional investors, so current yield by itself doesn't tell you a lot. Now, yield to maturity, which we've encountered a few times already, again, is oftentimes defined incorrectly as the rate of return to an investor who buys a bond and holds that bond all the way to maturity. But as we indicated earlier, that's only possible if you know the reinvestment rate, the rate at which you're reinvesting all the cash flows received prior to maturity. If you know that reinvestment rate in advance, you can't know that. So that's a bad way of thinking about yield to maturity, because technically speaking, yield to maturity is simply the single discount rate that causes the present value of the future cash flows to equal the current price of the security. So you'll note that says nothing about a rate of return. It's simply the discount rate that equates, again, the present value of the future interest and principal payments to today's market price. So really what that is, that you end up with a single discount rate. In fact, if we did the calculation here, the actual value we would get for I when we, the actual value we would get for I when performing the calculation, which by the way is done through an iterative process, through a process of trial and error. You plug in what you think is the value of I. Based on your single value of I, compute the right-hand side of the equation, then compare that to the left-hand side. If the two sides are equal, you guess the right value of I. Almost certainly your first guess won't be right. So through a process of trial and error, you go over and over guessing what the value of I is until you finally guess a value of I that causes the two sides of the equation to be equal. Well, note in this formula, the I you calculate would be approximately 0.027, because what you're finding is the periodic discount rate. So the convention then for turning the periodic rate to the annual rate is to simply multiply by the number of compounding periods per year. So 0.027, 2.7% decimal terms. Since this is a semi-annual pay bond, if I multiply the periodic rate by 2, that's how we get the annualized yield to maturity on the security. But you'll note a single discount rate would clearly not be the right way to value cash flows over time. Now note, this is exactly how you price a bond. If we were trying to calculate the price rather than the yield, we discount all the cash flows by that single discount rate. So that's bond pricing. But if we're really trying to understand fair value, we'd probably want to discount one period cash flows by one period rates, 2 period cash flows by 2 period rates, and by the way, in 10 years that should be 20 semi-annual periods. So we'd want to discount a 20 period cash flow by a 20 period rate. That's 20 semi-annual periods, of course. Well, where would we find a whole array of rates to estimate the fair value? Because note, using the I's indicated by that subscript, what I would be calculating is not the price, but my estimate of fair value. Right? Well, where would we find a whole array of rates to value cash flows dispersed widely over time? Oh, from an analytically derived yield curve known as the spot rate curve. So that's the process for valuation. On the other hand, the process for pricing is to discount the cash flows by a single rate. Clearly, that would not be a good way to estimate fair value, because if you have cash flows dispersed widely over time, chances are the risks associated with those cash flows, the liquidity, the purchasing power risk, the credit risk over different time periods is probably not constant. That's why for valuation purposes, we'd probably want to use rates that were appropriate given the timing and the risk of the cash flow. But for pricing purposes, if we're quoting things on a yield basis, we want everyone to interpret that yield as meaning the same dollar price. So a single discount rate is not the right way to value a bond, at least if you're trying to estimate fair value. It's the way to calculate the price or the market value of the security. So that single discount rate could only be a rate of return if we make very unrealistic assumptions. That single discount rate, the re-expression of the price, the yield to maturity in other words, is simply an alternative way of expressing the value of the security. You might say, well, that's what the price does. But expressing the value on a yield basis gives you a more effective way of comparing what you're paying today per dollar of future cash flow across all bonds. Putting them on a yield basis is a way of putting their cost on a common footing, if you will. And one final issue in that regard, if we look at the next exhibit, here on the right-hand side of the page, you see the yield to maturity formula. Excuse me, on the left-hand side of the page. On the right-hand side of the page, you'd see the formula for calculating rate of return. What's the likelihood if we did these two calculations today for a bond and then calculated its rate of return to maturity? What's the likelihood that the I, that is the yield to maturity we would calculate today, is going to equal this rate of return, which would depend on the cumulative value we've realized over time divided by the initial price and then adjusted to turn that into an annual number? Well, of course, those two are very unlikely to be the same value. That's why I've said several times already that while most basic books define yield to maturity as a rate of return, it's much more appropriate to think of yield to maturity as an expression of current value, that is, as an alternative way to the price of expressing what a security is worth today, but expressing it in a fashion that allows us to better understand what we're paying today per dollar of future cash flow. Oftentimes, market participants will use something known as a yield curve to get insights into a given market sector and at a given moment in time the rates or yields, because a yield to maturity is a type of interest rate. So looking at the rates or yields across various maturities at a given moment in time, or by comparing the yield curve for a given sector that we're looking at today versus where that yield curve was 3 months or a year ago, we can see how interest rates across all maturities have shifted over time, or the way economists say it, how the term structure of rates has changed, or by comparing the spreads between different yield curves and how those spreads have changed over time. Those are all different ways analysts or investors in the fixed income market will use the pattern of yields over time and how they change over time to get some insight into the relative attractiveness of different sectors, one versus the other, or a given sector over time. So let's talk briefly about yield curves and how they're constructed, and a little bit of interpretation that we might be able to draw by viewing yield curves in the fashion I described previously. So first off, each yield curve, or each fixed income market sector, would have its own yield curve. So on a given yield curve, what you're looking for ideally are a bunch of bonds we could say are homogeneous. That is, bonds that are ideally exactly the same as one another, or at least are as similar as possible to one another, with one exception, of course. That is, except with respect to time to maturity. Because, of course, with a yield curve, what we're trying to view are the interest rates on different maturity bonds from a given sector. And so, in other words, homogeneous. In other words, what we would like is all the bonds as much as possible to have the same credit risk, to have the same compounding frequency. Remember, that's a reference to the frequency at which coupon payments are made over the course of the year. We'd like the bonds to have the same optionality. That is, we'd like all the bonds to have the same sorts of embedded call options or put options. Now, of course, that degree of homogeneity, that degree of similarity never exists as it would in the ideal world. So that's why we have to, if we're trying to estimate the fair value of securities, as I was referencing previously, we can't use the type of yield curve that I'll construct as an illustration here, but we'd have to use an analytically derived yield curve known as a spot rate curve. But consequently, that means we'd have different yield curves for the government market, and the government agency market would be another one. Not a single yield curve for all corporate securities. Each different credit sector of the corporate market would have its own unique yield curve. And we'd have to have separate yield curves for other sorts of issuers. Mortgage-backed securities will be on a different yield curve than any corporate curve or government curve. Municipal securities or regional or provincial debt, its own yield curve as well. And when we're looking at the yields, that is the interest rates in any one sector, remember what those interest rates are going to be reflective of. They're going to be reflective of the inflation-adjusted rate, that is the rate without taking into account inflation, plus any expected inflation. And those real interest rates that I was talking about before, real interest rates are primarily a function of the supply and demand for credit. I guess I should say supply of and demand for credit. Because naturally when the economy is strong, i.e. businesses can generate high profitability from investing in plant and equipment and new products and worker training, well, there's bigger demand for capital, likely to push interest rates up. On the other hand, when the economy is really slack, there's a lesser demand by businesses to invest in expanding their productive capacity because they probably already have adequate capacity. So in a slack economy, the demand for capital is down. That tends to result in lower interest rates. Clearly, interest rate determination is way beyond just a matter of supply and demand for capital. That determines the real rates. On top of that's expected inflation, as well as a wide variety of other factors, but those are some of the most important considerations. And remember before I was talking about how corporate yield curves will be displaced somewhere above the government yield curve typically, because corporate issuers represent riskier investments from the standpoint of fixed income investors. And those corporate yield curves will be displaced above Treasury yield curves because of the risk premia. That is the multiple types of risk we face to a greater degree with corporate securities versus government securities. And especially that relates to things like concerns about the issuer defaulting, or the fact that corporate securities are going to be less liquid, or the fact that corporate securities are more likely to include embedded options. And all those factors will cause corporate yields to be displaced somewhere above government security yields. So let's look at a hypothetical yield curve here. And I say hypothetical because there is such a yield curve, the U.S. Treasury yield curve. But in this case, these are made-up values. They're not reflecting values in the market today specifically. So the Treasury yield curve as it's created today in 2013 is based on 10 different rates. So what you see are the rates on the Treasury bills. So those are all rates drawn from the Treasury bill market, although there's specifically what are known as bond equivalent yields because they take the discount rate, the interest rate that reflects Treasury bill values, and converts that to put it on a common footing with bond and note yields. The 2, 3, 5, and 10-year rates are taken from the various issues or maturities of Treasury notes. And of course, the 30-year rate is based on a Treasury bond rate. And you'll note the description on this exhibit says these are the on-the-run Treasury bills, bonds, and notes. Well, on the run simply means the most recent issue. of any given maturity. And these are the 10 maturities that the U.S. Treasury is currently issuing today. Now remember that I said we want the securities from which we're building any given yield curve to be as similar to one another as possible. And you'll note these are only 10 of probably more than 250 different issues of Treasury securities outstanding today. So all Treasuries are either on the run or alternatively they would be considered off the run. And off the run means simply any other issue than the most recently issued one. So you might recall that I said there's something north of 250 different Treasury issues outstanding. Well, most of them are off the run. These on-the-run issues are only on the run for somewhere between 1 week and maybe as much as 1 quarter before another new issue of that same maturity gets issued. Well, the reason we want to use just the on-the-runs is because the on-the-runs tend to be more liquid. And they're more liquid because of the fashion in which Treasuries get issued. We'll talk about that later. And so we want to use the securities that have similar degrees of liquidity, that is, similar degrees of liquidity risk. And mind you, I'm not saying the off-the-run issues are illiquid. Even the most off-the-run Treasury security is still going to be more liquid than the most liquid corporate security. It's just that the off-the-run issues are less liquid than the on-the-run issues. And again, in trying to honor that requirement that the bonds we're using to build, or the fixed income securities we're using to build our yield curve, are as similar to one another as possible, that's why we'll restrict ourselves to only using on-the-run, but not mix on-the-run and off-the-run in a single yield curve.
Welcome to Bond Contract Features and Investment Characteristics. In this activity, you will apply key concepts from this section. You will complete 5 steps over the next 60 minutes. Step 1 helps you identify key features of a bond contract. Step 2 guides you to calculate accrued interest using a day count convention. Step 3 focuses on identifying types of risk with real-world examples. Step 4 helps you calculate the yield to maturity of a bond. And finally, Step 5 asks you to draw and interpret a yield curve. Let's get started and apply what you've learned in a hands-on way.
Let's look at some of the impact that those greater risks on non-government debt will have on yields and how that affects the yield curve of the non-governmental fixed income sectors. So here you see an exhibit that has a hypothetical government bond yield curve. So you're seeing the yields across different maturities. And you'll note how we've labeled these government rates risk-free rates. Understand, anytime you hear the phrase risk-free rate or risk-free security, in your own mind you have to insert the word default in front of that phrase. So it's properly only default risk-free rate, that is the rate on these risk-free securities, or the default risk-free security itself. That's generally a way of referring to government debt issued by governments that have a fairly strong tax base that they'll be able to collect revenues off of. So clearly such government debt, like debt issued by the German government or the US government or the Japanese government, among many others, it's considered risk-free as we're talking about here, but it's clearly not free of all risks. There's still the impact of inflation and what that does about the uncertainty of the purchasing power of the monies we'll get in the future. Such securities will still have unpredictable future prices because we don't know how interest rates will change and the prices will move in the opposite direction. There's still the reinvestment risk unless it's a zero coupon or strip sort of issue. So government securities are not free of all risk. So when you see that phrase risk-free rates, that is the rates on such securities, the yields generally, or risk-free securities, those are the securities issued by the types of governments I talked about previously, but you clearly have to recognize those as not free of all risk. They're simply free of default risk, because governments have the ability to legally impose taxes which they can collect from businesses and individuals, elsewise those business people or individuals are in jail, or governments can create money out of thin air. That's what the quantitative easing that is being conducted currently by the BOJ, the Bank of Japan there, or the BOE, the Bank of England there, or the Federal Reserve in the United States, they're creating money out of thin air as a way of trying to spur greater levels of economic activity. But that means that such governments would never have to default because they can pay off their debt by creating money out of thin air. But if you're talking about corporate securities will typically trade at higher yields for any given maturity. In other words, if we were looking at a 10-year set of maturities, well, the 10-year T-note, 10-year U.S. Treasury note, is going to be trading at a lower yield than a 10-year even AAA-rated security, because corporate securities face greater risk. And that greater risk will cause the market to require those bonds be sold at a higher yield to maturity, which means that there's guaranteed a higher return, because of course these securities might default or they might have a credit rating downgrade. A higher yield to maturity simply means you're paying less money today for each future dollar of contractual cash flow. You're paying less money today for each dollar of future interest and principal payments. Well, because you face risks, greater risk with corporate securities, they're less liquid. There's a greater possibility of default because corporations have to sell something to someone who's willing to buy it from them to raise money to service their debt. Now, ideally, corporations are selling goods or services they've produced profitably, but it doesn't have to be that. They could be selling things at a loss to raise money. They could sell assets to raise money. Corporations can issue securities to raise money. So there's a variety of ways corporations can generate money, but they don't have the force of law to force the counterparties in transactions to hand the money over. So businesses have to convince someone to buy something from them, or they have to be able to sell something to somebody else to raise money. And because of that greater uncertainty you're facing with corporate bonds, for any given maturity, corporate securities will trade at a higher yield than governmental securities. And aside from those risks, of course, the embedded options also affect those spreads, as we talked about previously. But those credit risk issues and embedded option issues we'll talk about later when we're talking about market segments where those sorts of risks are a significant consideration. So if we start looking at the individual types of securities, let's consider the safest securities first, the quote-unquote risk-free securities. But again, properly thought of, it's the default risk-free securities. That's generally how investors think of most governmental debt, although as we'll see, that's not always a safe assumption. But if we look at the characteristics of government debt, you might remember I had earlier said that in any given national financial market, the government is typically the biggest issuer. Well, because there's more of those securities outstanding than any other type, chances are they're going to be the most liquid of those securities in that market, both because of them being a larger number outstanding, which means they're a better trading vehicle, as well as the fact that governments are typically the most creditworthy borrower in any given economy, again, because of the ability to impose taxes or create money. Not necessarily true, especially in emerging markets or lesser developed countries. You might have a government in financial difficulty, and yet there's a domestic corporation that has a global business. So you might, in some rare instances, see individual issuers with better credit ratings than the home country government, but that's extremely rare. So because of that greater safety than other domestic issuers and the fact that it's typically the largest segment of any national fixed income market, usually government securities are the most liquid securities in that national financial market. And the safety I referred to earlier, we talked about that risk-free discussion. Again, default risk-free is the right way to think about it. And note, for those conditions to hold, two factors must be present. We mentioned these before, but just to highlight them. The issuer has to have a significant tax or revenue base. Now, for the vast majority of governments, that's going to be a significant tax base because the government can impose income taxes on individuals, various income and other sorts of taxes on businesses, and so that might be the primary source of revenue. Although in many lesser developed countries or emerging markets, the government might have other sources of revenue, because in many such economies, the government is the primary owner of many natural resources, or in fact, they might own many businesses. So those might be other sources of revenue beyond things we would narrowly consider as taxes. But in addition to having that strong revenue base, for the government securities to really be considered risk-free, you also need to have that government to have an independent monetary authority. That is, the ability to create money and manage the country's monetary policy. So, implication there is if you look at the European and surrounding countries that are part of EMU, Economic and Monetary Union, they have given up domestic control over their money supply. Money supply is controlled by the ECB, the European Central Bank, which means that while really strong economies like Germany, for instance, or the UK, reasonably strong, well, there's relatively small likelihood those governments will run into financial difficulty. But think about some of the EMU countries that have been experiencing financial difficulty, like Greece or Portugal, or Spain for that matter. They don't have the ability to create money out of thin air to buy back their debt. So for government debt to be really considered default risk-free, you need at least a strong tax base, and where the tax base might be under threat in a weak economic environment, then they'd also need to have an independent monetary authority. But even with government debt, you have to take into account various risk factors, because remember, governments make the rules. So they have to have a willingness as well as the ability. We were talking previously about their ability to service their debt. They also have to be willing to service the debt. You might say, well, if they have the resources, certainly the willingness isn't that important. Well, remember, most countries are at least nominally democracies, which means there are domestic constituencies that have to be kept happy enough to re-elect the government, or that's what the current government hopes. And so consequently, spending priorities will oftentimes intrude. So while there might be strong domestic revenues, the existing government might feel the need to support domestic constituencies as opposed to paying international bondholders. And in addition to that willingness, you also have to have the surrounding proper financial circumstances. And we can talk about twin surpluses ideally. Ideally, you'd like to see that government running a budget surplus. Their revenues are greater than their expenditures. And the economy as a whole has a balance of payment or balance of trade surplus. Not that those are necessary. The U.S. economy has been running a balance of trade deficit for 50-plus years and a budget deficit for, I think, all but 4 of the last 50 years. Nonetheless, because of a strong tax base and an independent monetary authority, U.S. government debt is considered default risk-free. And while many people mistakenly think sovereign debt is always risk-free, you've got to be very careful. In the long stretch of time, chances are all countries will ultimately default, because most of the countries in existence at this point in time have defaulted at some point over the course of their history. In fact, many governments, and I will not name any, but many governments have been serial defaulters.